Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video I'm going to share with you guys a company that we have not spoken about for a very long time. This is a company a lot of the brothers on the community on the Discord talk about a lot. They do own, quite a lot of them own this company. It's been on my basically not portfolio, it's been on my watch list for quite some time. And what I would like to do today is kind of give you an overview of the company, what they do, and then talk about the financials. Then we talk about valuation, the valuation side of things, and then I will tell you exactly what I will be doing and with this company moving forward, inshallah. I do not own it in this portfolio or in the family portfolio, so this will be an interesting one to look at, and exactly I'll tell you what I will be doing, inshallah, moving forward. Now the company we're talking about today is this company here, Deckers Outdoor Corporation. This is basically one of the companies, like I said at the beginning, that has been on my radar for quite some time. They actually are, I'm sure you've seen brands like a Hoka, for example, or Thifa or Hags, for example, which they acquired not long ago. So they are more or less like a holding company. They've got loads of different brands. I'm sure you've seen some of their shoes around. They are not cheap either. I was just looking at the prices of some of those basically women's shoes, for example, $125 per pair shoes and so on. So there are of course other companies that are competing with this company, and one of the things that's happening right now, okay, they do have excellent brands and so on, but one of the major things that we really need to be careful about this company is the fact that it's now, because of the tariffs, this company has been affected a lot. And since the tariff happened, I think it was the 3rd of April, the stock was down about almost to 14%, which means it was closer to basically decreased to about 50% a year to date on that day. So it was almost down 50% from the all-time since the beginning of the year. And a lot of that is because of what's happening with the tariffs. This company's product is made in China and Vietnam, and because of that it's basically been affected massively. Now again, that's still up in the air. We don't know exactly what is going to happen, and 100% of their product is made in those other countries, even including Philippines and so on. So they don't make any of their products in the US. So if I was to buy this company, I'm literally taking a bit of a risk, knowing that potentially this company's financials will be basically, it will impact their financials. Because remember, if they're paying more to basically make those products outside the US, then of course it's going to hit with their revenue, is going to hit their net income and all of that stuff, and the free cash flows might decline and so on. So it's a massive risk. But yeah, let's have a look at now financially where the company is. That is basically a little bit about the company, the risk potential that we're going to face. Now we're going to look at the financials and see if it's actually potentially, there's a huge risk we're taking, but we want to see if the company is really undervalued so much to the point that we are willing to take that risk. Okay, and as you can see, like I said, the year to date is down 42%. Now a couple of things I want to show you about the company, is one of the things that I was looking at early was basically the earnings report that they've released on basically recently in January. And as you can see here, third quarter 2025 revenue increased to 17% to a record of 1.83 billion. The third quarter basically fiscal year 2025 diluted EPS increased to 19% to record basically $3. So it's nice to see the company's revenue is growing nicely, 17% basically that quarter, and then 19% when it comes to EPS, which is absolutely amazing. And the revenue growth basically guidance raised approximately about 15%. Now this can easily change, because since they've reported, of course, Donald Trump has taken over and a lot of things has happened. So potentially this can change. I don't think the company has come out and basically made any changes to this yet, but we will see what happens. And the EPS, basically they're expecting about $5, 5.75 to basically $5 to 80 cents, if you like. So that's the first part. The second part I wanted to share with you guys is the net sales increased about 17%, which is absolutely amazing. They have a direct basically to consumer, which is basically they sell it directly to the consumers, and they also have wholesalers, which is basically increased about almost 18%, this one, and this one increased about 16%. So wherever you look at, this company has reported absolutely amazing basically sales, and amazing, everything is heading the right direction. Basically it's a very high growth, if you like. Again, domestic increased about 11.5%. International net sales increased about 28.5%, which is really good to see. Gross profit, gross margin was basically 60% compared to 58% basically last year. So really good. I really like that. And then of course they've got some expenses and so on, which we will be looking at in a second. Now this is basically their earnings per share since 2015, and as you can see here, every single year it has been increasing since 2015. When you look at the free cash flow per share, it also has been increasing. Apart from this, the next 12 months, they expect a slight decline on that, which is absolutely fine. Now, when you look at the shares outstanding of this company, they have been buying their own shares, which is really good. And I like when companies buy their own shares, especially when the stock is down quite a lot. And the total sales here, you can see from 1.8 billion to right now almost to $5 billion. So it's every year has been increasing since basically 2015, and even 2020, when there was of course it's like, you know, the whole general markets were down and so on, the company's revenue is still basically increased, which is really nice to see. So 2019 sorry, was basically $2 billion, and then it was $2.1 billion the following year. So there was no actually decline in sales, which is really nice to see. Return on equity, return on invested capital is absolutely wonderful, and this is probably one of the reasons why I'm really attracted to this company, and one of the reasons I wanted to look at this company, because this is a high quality business, very well run business. Return on equity, return on invested capital are doing well. Operating margins of 24%, free cash flow margin of 20%, and almost zero debt, which is really good for this company. Again, it's not a huge basically market cap. It's basically about $17 billion when it comes to market cap, which is absolutely fine. Now look at the financials. I want to look at we've seen the revenue side of it. Okay, so this is how much they made, this is how much they spent. So they spent half of basically what they've made, and the gross profit, we're looking at about $2.8 billion of that 4.9, which is really nice to see. Of course they're going to spend some money on taxes and all of these things, and research and development and so on, but the net income is about $1 billion. So it was $500 million. It's increasing every single year, and I hope that continues in for the next couple of years. We've already seen the EPS increasing. Now the other thing I want to check is we've already seen the debt level. Now I want to show you quickly the total current basically assets, which is $3.2 billion, against total current liabilities, okay, which is basically $1 billion. So that liability is completely covered, nothing to worry about, and total liabilities of $1 billion against total assets of almost $4 billion. So this company is a very healthy business. So this is why I'm not too worried about even if basically China's situation continues for quite some time, and the company loses a little bit of money here and there about the basically with regards to the production side of it. Again, if they had a very high level of debt, then I would stay away from it, because you would not want that situation to get worse because the company is getting into more debt and so on. But the fact that they have almost zero debt is really good. Now earnings expectation is moving forward for this company. Okay, this is again another reason why I'm attracted to this company, because March 2025, which is basically now really, well, we're in May, so they must have reported already the year. It's basically they're expecting about 21% year-over-year growth. Okay, 2026, so next year, this time basically around this time next year, they're expecting about 8% growth in terms of EPS. Then 10%, then basically 14%, and so on. There's a lot of analysts that are looking at this company, which makes me, you know, really, it's important to check how many analysts are looking at, because if it was a one or two, then you don't want to take their word for it kind of thing. And then also when we look at the revenue side of things, you can see we got about almost 16% basically this year, and the next year we're expecting about 10%, almost another 10%, another 10%, another 10% for the next, at least to, you know, up until 2029, which is really good to see as well. Now we're going to look at the valuation side of things. So if I go to fast graph, for example, and click max, you can see below the orange line basically is the fair value basically for this company. And when this black line here is below that line, that means basically the stock has been undervalued. When it's above, basically that means overvalued. So there's been years and years where it was below that line. Okay, as you can see there, especially I think 2020, right there, if you bought it there and sold it when it was so high, you would have made, at least for £10,000 into dollars invested, you would have made $97,000. Okay, but of course, right, if you bought it here when it was too expensive and sold it right now, you would have lost 92% basically of your money, which is absolutely ridiculous, or 50% overall for basically total rate of return. And this is why really valuation is very important. And right now, as you look at it's below that orange line, it's below that, basically just hitting that, the blue line. The blue line is basically what Mr. Market has been valuing this stock for quite some time. If we reduce that, as you can see here, that's about 20% and operating earnings growth rate for the last basically since 2004. Now if we look at basically the last 10 years what the company has been, as you can see, it actually seems discounted. That's it, again, it's about 23%. When we look at the last 5 years, as you can see here, is about almost to 20%, and also we are still below that basically line. Now if I click forecast, because that's the important part for us to see basically where the company is heading and if we're going to make any money basically on this if we bought it today. So we're looking at basically 15 PE, which is that line there. If we bought it right now, basically based on this, and remember the blended PE right now is about 20. Okay, and if we were to buy it right now, basically we wouldn't make any money right now, basically based on the where the stock has been trading the fair value basically. But if we use the normal multiple, which is what Mr. Market likes to trade this company for the last whatever years, which is about 20, and we go to 20 right now, there you'll be making about 11.5%. So again, this is a decision that you need to make. Are you gonna basically use the 15 PE, or are you gonna basically listen to Mr. Market and what it's been trading over the over the last whatever years and basically use that? Again, that's a decision that you need to make. Now if we click performance, I just want to see how this company has performed against the S&P 500 for the last 10 years. Okay, remember they don't pay any dividends, so this is all price appreciation. If you invested $10,000, okay, around basically about 10 years ago, right now you would have made an annualized rate of return of 33%, almost to 34%. The S&P 500 only about 11%. Now basically the compound is about 33%. We've already seen that. So against that 12% of the S&P 500, so you would have actually beaten the S&P 500 massively, because your 10,000 would have given you right now 78,000 US dollars over basically in comparison that 21,000 US dollars for basically for the S&P 500. And this is why it's important to also buy companies when they're undervalued and so on. This is a high growth company right now, the way it seems, because as you can see here, the 2025 is expected to grow about 22%, 11% in 2026, 2027 about 7%, and then 13%. So that's very decent when it comes to growth side, basically the EPS side of things, which is really interesting. And now if we look at the valuation for Morningstar, okay, if we check this, you can see here it's 3 stars. Okay, it's a narrow economic mode. $120 per share is where they think the price should be, is around that right now. So more or less fairly valued, which is basically what we have seen here. If we're using basically the forecast and we're using that basically 15 PE, is flat basically right now. It's more or less basically you're not going to make a lot of money. However, if you're using the normal multiples and you basically hold on for this company for the next 3 years, and remember this is up to 2028, so by 2028 you would have made about 11.5% to basically annualized rate of return, or total you would have made about 37%, which is quite nice to see. So what I have done now is basically I actually bought this company for the family portfolio, and this is the purchase that I made just today. So I bought 5 shares of this company, average price of $118 per share, and my cost was $592. So I was done straight away. Of course, as soon as you buy it, normally goes down. So what I'm going to do is, inshallah, I'm going to continue purchasing a little bit here and there wherever I get a chance. I really like the company. I like basically what they do, and I like the fact that they've got, the growth side of it is good. And yeah, so, and I'm going to take that opportunity. It's a bit of a risk, like I said, because this tariff situation can go south completely for this company, and if it happens, I'm just happy to buy a lot more and just keep dollar cost averaging down into whatever it goes down. I hope it goes down to 93 or even below that, because I'm willing to buy, because the brands are really good. They've got absolutely amazing brands, but the issue will be to make those products, they might have to put a lot more money into it. So yeah, that's the company that I wanted to share with you guys. If you enjoying this type of content, of course join us on the Discord, where a lot of brothers are sharing very good practices. It's free, you can join that. If you haven't joined us the Patreon account, it makes a huge difference to the channel, of course. And yeah, if you can join us, that will be absolutely amazing. Have a wonderful day. Assalamu Alaikum.